Trust company. My name is Haley Gant, and I work pretty hard with the rest of our marketing team to put on all of these events, webinars, and education for you guys. So I'm actually really excited for today's class. Today we have with us Cody Laughlin and Brian Alfaro from Blue Oak Capital here in Houston, Texas. And they're going to be talking about some of the big things that you should be looking out for when you are looking to passively invest into syndications. Now, before we get started, I do just have a couple of quick announcements for you guys. I know in a lot of these webinars, we get a lot of current clients that are joining us. We get a lot of people that have been watching our classes for a long time, but we also get a lot of new attendees with us every single week. So if it's your first time joining us, welcome. I hope you enjoyed today's class. Today's class is just one of many different educational webinars and presentations that we put on here on our platforms at Quest. And we really enjoy teaching investors all over the US about not only self-directed IRAs, but various types of real estate investments as well. So you guys can go out there, utilize this knowledge, and improve your real estate investments and your just knowledge in this space. Now, a quick little tidbit about who is Quest. At the core of our business, Quest Trust Company is a self-directed IRA custodian. So we act as a custodian over IRA accounts, and our clients actually use their IRAs to invest into assets outside of the stock market. So at Quest, we specialize in holding privately held assets where most traditional custodians like Fidelity, Charles Schwab, their platforms are only set up to allow you to hold publicly traded securities. But what a lot of people don't know is that you can actually use your IRA to passively invest into multifamily deals, private equity deals. You can use your IRA to be a private lender or directly purchase real estate. So it's a great way to diversify your retirement portfolio. And again, we do a ton of education over all of these topics because self-directed IRAs, it's not really something that a lot of people are experts in. So at Quest, we're very passionate about teaching people about how this works, how you can build wealth through non-traditional assets held in your retirement account. And we also have a pretty awesome team behind the scenes. If you guys watch our classes and events, you see a lot of the type of content that we put on, but what some of you guys might not see is the other 100 employees that we have all amongst our Texas offices from Houston, Austin, Dallas, that we're here to help you learn how this process works, get your account open, get your account funded. And once you're actually using your IRA to invest into these deals, our transactions team is awesome. They'll get your deal funded in about 24 to 48 hours from the time that we have your documents that we need. And a lot of us are actually also CISPs, which is a Certified IRA Services Professional. Basically means we worked at Quest for a long time, over 2 years, and we've actually passed a test by the American Banking Association. And this designation is not easy to achieve, but a lot of our staff does have the title of a CISP. So we're always here to help with your tough questions when it comes to investing with your self-directed IRA. Now, quick disclaimer, this is so important. Please be aware that at Quest, we do not give tax, legal, or investment advice. We bring in a lot of guest speakers. We put on a lot of education because we want you guys to have confidence in understanding how these investments and transactions work. But please make sure that you are always doing your own due diligence before you enter into investments and that you're taking the time to make sure that you use professionals to structure your deals properly. Really cannot stress that enough. But again, if you guys have questions, let us know. We're always happy to help. And you'll actually see one of my coworkers, Evan, in the chat right now. Evan is one of our IRA specialists. And where my job is to put on the events for you guys, Evan actually helps in helping our new clients get started with their accounts, going through one-on-one consultations, learning how it all works. So be sure to reach out to him if you have questions. He'll be online with me throughout today's entire webinar, and we're always happy to help answer those tough IRA questions for you. Now, moving right along, I do just have a couple of quick announcements about some upcoming events and promotions that we have going on right now. But I did want to take a second to share some information about our online client portal. This is extremely helpful if you have an IRA at Quest make sure you log in online to the online client portal. We have a lot of great features in there that you can use to keep up with your IRA account, the investments that you're holding in there. And you can now actually upload all of your investment documents and information directly online to the client portal through our new feature called the QTC Investment Hub. So you no longer have to fill out any forms. You can just upload everything directly online. And there's a lot of other cool features through there as well. But this is a really great way to keep your account and your investments secure. You can keep your personal information out of your email and just upload everything online directly through our client portal. Now, as I mentioned in the beginning, today's class is just one of many classes and events that we host at Quest. We have a lot of different resources. Our YouTube channel is a fantastic resource. You can actually rewatch today's class as well as all of our other classes directly online through our YouTube page. We have a lot of information on our website. We host about 3 to 4 online webinars every single week. And you'll see here on the next slide, we are actually bringing back our in-person events in our Texas offices, starting in actually less than 1 week. But if you guys are unable to make it to our events in person, or maybe you're not located near one of our offices in Texas, be sure to check out our online virtual networking happy hours. We started these events up literally out of necessity. I had people calling me every single day over the past several months, like, hey, I know the classes aren't coming back yet, but I really want to network with people. So just out of all of those calls that I was getting every single week, we actually started a virtual networking happy hour. It's twice a month. And this event has really taken off. It's the first and third Wednesday of every single month. And at every happy hour, we get about 40 to 50 real estate investors from all across the US. Everyone gets a chance to share their cameras. Everyone gets about a minute to introduce themselves to the group. So I would definitely recommend that you guys check these out. They're one of my personal favorite events that we host. And you'll get a chance to kind of meet and connect with some more of our IRA specialists on these happy hours as well. Now, my most exciting announcement, at least in my opinion, that I have today is our in-person events are coming back. We have grand opening events in all of our Texas offices starting next Tuesday, August 3rd at 6:30 p.m. And then in Austin, it'll be August 10th, Tuesday at 6:30 p.m. And then in Dallas, last but not least, on the third Tuesday of this month, August 17th. And these are going to be a lot of fun. We'll have drinks, we'll have food, vendors, and networking. And you can register for all of these events directly through our website. And if you guys are not located in Texas, be sure to check out our events that we have posted online, because we will continue to live stream all of our events just as we have been over the past year. But if you're in Texas, Houston, Austin, or Dallas, be sure to come check these out. They're going to be a lot of fun. And we have just over 250 people registered for Houston, and Austin and Dallas are not too far behind from that. So it should be a great event. And if you guys are looking at getting started at Quest, or you're a current client looking to do a new investment, we do have a promotion going on right now through the end of July. I think we might be extending this one a little bit as well. So definitely, don't wait or be sure to reach out to us. But we're giving away up to $500 in fee credits for new clients and existing clients. If you transfer funds into your Quest account, you'll potentially earn up to $500 in fee credits. Again, if you guys have questions about that, reach out to Evan. He's one of our IRA specialists. He'll be online on this webinar throughout the entire class. And if you're rewatching the replay, just reach out to us at sales@questtrust.com, and we'll be happy to have you there as well. Now, if you are a current client watching our webinars, make sure to tell your friends about it. We have an awesome referral program. For any person that you refer to Quest, you will each get a $25 credit to your accounts. So make sure you tell other people about this. Guys, in real estate, you know how much business we all get through word of mouth. So be sure to share this information with people around you, because having the ability to actually take control of the investments that you hold in your retirement account can really be a game changer for a lot of people and their ability to build wealth. So tell your friends about it, reach out to Evan. He can give you all of the details there. But this is my last slide. Guys, reach out to us. If you have questions, we're always happy to help. If you have people that are looking to invest with you that have questions, send them our way and we can walk them through every step of the process. But without further ado, that is the end of my announcement. So I'd like to go ahead and bring back Cody and Brian. Cody and Brian are multifamily investors here in Houston. They actually have a really awesome meetup as well. I believe it's the South Texas Multifamily Meetup. I've attended it myself. So, it's always great to see other people in the industry that have similar mindsets that are here to help educate others and bring people together. So Cody and Brian, if you want to go ahead and come on, share your cameras, and we'll kind of go ahead and get into the main presentation from here. To all of our attendees out there, if you guys have questions throughout the class, put them in the Q&A box and we'll come back on at the end and answer any questions that you guys have. So Brian, Cody, great to have you here today. Y'all go ahead and take it away.
Awesome. Haley, thank you. I was going to say, thank you for the warm welcome. Great job.
Yes, absolutely. Haley, thank you so much for allowing us to be here with your audience today. And both as a Quest STIRA account holder myself, my wife included, and a frequent visitor of the Money Mixers prior to COVID, I'm very, very excited to be here and, share this stage with you guys. And I am looking very much forward to those live events coming back. So really, really excited to hear that. So, but I'm going to go ahead and share my screen here and we'll get right into it. Let's see. All right. Brian, can we see that? Can you see that?
Yes, sir. You're good to go.
Awesome. Well, again, guys, to the general audience that's here, most of you have, obviously are here to learn more about investing in direct private real estate. And, one of the things that we love about real estate is the different investment strategies and asset classes that you can invest in, both as an active investor or passive investor. And, from myself, being both an active and passive investor, there's a lot of leverage in being able to participate in both, right? And so, but really what we're here today to talk to you guys about is avoiding some of the big mistakes when passively investing in direct private real estate, and particularly private placements, okay? And most of you here have either been exposed to the term syndication, maybe you're invested in syndications. Very, very powerful strategy, which we'll talk about here in a second, to get involved in direct private real estate. But there are some things that we need to know. So today we're going to go over, again, just kind of who we are, Brian and myself and Blue Oak Capital, a little bit about what exactly is syndication for those who may not be familiar with that term. We'll talk a little bit about what helped syndication become very mainstream in today's time. Again, those big mistakes to avoid when passively investing, and then we'll go into a Q&A. So Brian, you want to introduce yourself?
Absolutely. So Haley, thanks again for having us. Cody, appreciate the introduction. Looking forward to speaking with everybody today. My name is Brian Alfaro. I am born and raised in Houston, Texas, and we are still here in Houston, Texas. I am a small business owner here locally. I have a couple of coffee shops on the west side of Houston that I also focus on as well. But as Cody mentioned, we are multifamily real estate investors. And I am a general partner in 240 units here in Houston, and I still have a small single family portfolio as well. And I've been able to translate my business degree and my business skills at my small business into the multifamily and real estate space over the past few years. And I started investing in real estate in 2018 and just looking to grow my portfolio and network with other great people.
Awesome. Thank you, Brian. Ooh. Sorry there. And again, my name is Cody Laughlin, one of the three managing partners here at our company, Blue Oak Capital. I started my real estate journey back in 2010 when I became an accidental landlord and spent some time in the single family space after that, doing a variety of different strategies, including wholesale, single family flips, and buy and hold. And, really realized that really was a difficult model to scale, at least to fit my investing goals. And so made the transition to focus exclusively on multifamily in 2019, and was fortunate to meet the two best partners, Brian and our third partner, John Beatty, who's not here with us today. And we formed Blue Oak Capital with the intent to continue to scale our multifamily investing business. But as Brian just alluded to, we do hold ownership interest in 240 units as a general partner. And also I personally am a limited partner in 128 units along with my wife in a deal in another market. So we've together founded our podcast, the Prosperity Through Multifamily Real Estate Investing podcast. And as Haley, as you mentioned, we also co-host both a live and virtual meetup event. That is a great networking opportunity for anybody looking to come out, which we'll share with you guys later. But by day, I am still a full-time W-2 employee. I am in the healthcare industry. I graduated in 2008 with my bachelor's degree in the science of nursing. And I've been a practicing registered nurse here in the Texas Medical Center since then. So, all right, so let's get into it. So really, what is exactly syndication, right? And so again, for those of you who may not be familiar with this term, basically syndication is, if you think about the partnering of other people and the gathering of resources to go out and purchase assets that typically you would not be able to do on your own, okay? And if you think about kind of your own financial circumstance and what you have in the bank, if you think about a real estate transaction, typically you're putting 20 to 30% down, and if you're looking at multifamily buildings like we are, multi-million dollar valuations, not everybody has that type of liquidity to purchase those assets. So syndication allows us to really pull investor capital from other investing partners and go take down bigger deals, again, that we couldn't do on our own individually. So if you're not familiar with syndication, that's okay. This has actually been a strategy that's been around for many, many years, but historically has been kind of more of your country club type of strategy, so to speak, your high net worth individuals that would talk amongst their peers at the country club. And it was really kind of behind the door, so to speak, strategy, but really started to become mainstream over the past decade, which we'll talk about here in just a second. But the cool thing about syndication is really you can practically syndicate anything. I mean, any fixed assets, really there's very few limited restrictions on what can be syndicated, to add to your investment portfolio. So it allows you a lot of flexibility and a lot of economies of scale, which is very, very powerful. So we'll move on here. Brian, you want to talk about this?
Yeah, absolutely. Appreciate it, Cody. So as Cody mentioned, syndication is something that recently got popular, but has been around for quite a long time. So you have to ask yourself the question of why has syndication gotten popular in the past, let's call it 10 to 12 years. And a big reason that syndication has gotten popular has to do with the Jobs Act, which was passed in April of 2012. So after the depression, the economic recession of 2008, the government was looking for creative ways to sort of jumpstart the economy, particularly in the real estate market, because as we all know, what happened during 2008, housing prices plummeted, commercial real estate prices plummeted, and they were looking for a way to incentivize investors to invest their capital in these hard, tangible assets and provide some incentive for that. So prior to this Jobs Act, as Cody mentioned, investing in syndication was really for sort of like the good old boys network. There were people who were accredited and that they could invest in these pools and these deals. But after the Jobs Act was passed in April of 2012, it allowed funding to be raised through what are called crowdfunding portals. Some of you may have seen crowdfunding websites where you can invest in different things. And this really came about after this Jobs Act was passed in April of 2012. And like I said, the main goal was to help keep private businesses private, but also to put some money into these deals and to make sure that these real estate assets would go up in value over time, which Cody and I both know has seemed to work pretty well. And also one thing about the Jobs Act of 2012 is it made a regulation change to the SEC regulations regarding raising private equity from investors. Prior to this, if you weren't accredited, you weren't allowed to invest in these real estate deals. And there was an exemption that was created, which is called the 506B exemption, which allows real estate investors to actually raise capital from what are called sophisticated investors. So before that, if you weren't a sophisticated investor, it was really hard to get into these deals. You had to be accredited, which usually means you have at least $200,000 of income, $300,000 if you're married, or you have over $1 million in net worth. So It really opened up the floodgates and allowed people to start raising capital from different areas. Before, you might need $100,000 or $200,000 to put in a deal, and investors were able to go out and pull resources from people that were educated and sophisticated and be able to raise smaller funds, $5,000, $10,000, $25,000, and that really opened up the floodgates for syndication. You want to go to the next one, Cody? So because of the floodgates being open, a big thing you'll notice, kind of what we're doing here, is there's an increase in educational programs teaching real estate syndication, not only to active operators, people like ourselves who are looking to actually put the deals together, but also to passive investors, because the last thing you want to do with any type of investment is to go into it blind, to be uneducated. So there's really a lot of people that stepped into the space who either were in the space prior to this Jobs Act, or that got into the space and started providing educational content through networking groups, mentorship groups, masterminds, YouTube, and different platforms. And that has caused thousands of new syndicators to enter the space, us being one of them, to help raise private equity, because they understand how such a powerful tool this can be. But with all that being said, because there are a lot of syndicators running around, it presents an opportunity for a lot of high risk investments and a high risk exposure to people that are interested in passively investing. If you're not doing your due diligence, if you're not vetting the sponsor who's putting the deal together, and you're not sophisticated, meaning you're not getting educated on how these deals actually work and asking the right questions, you essentially are putting yourself in a high risk environment. Even though the numbers might look good, you really need to understand the overall business plan.
Yeah, Brian, that's a great point. And that's kind of the basis of our presentation today, is to really help you understand some of the intricacies of the mistakes to avoid when passively investing in these private placement offerings, right? Because, they are very long-term commitments. They're very illiquid investments. And so you really want to make sure that you're coming in with a certain level of sophistication and education before getting yourself exposed to some of these opportunities. Okay. And so we're going to kind of lead off right there for talking about some of our big mistakes to avoid. And, we tell people this is not the end all be all when it comes to, there's many, many mistakes you can make in investing in these offerings, but these are the big ones we feel like you really need to put most of your emphasis on when it comes to your general education. Okay. And so the first one, being probably one of the most important, is we talk about vetting your sponsorship team. Okay. These are your your operators who are actually finding the deal, articulating the deal, putting the deal together, getting the deal to present to you as a passive investor. And so in these offerings, when you're really looking at vetting an opportunity, you're really betting on the catchphrase, right? The jockey over the horse, right? And so who's running the ship, so to speak? And so one of the big mistakes that we see most often is passive investors not taking the time to vet the sponsorship team. And you'll hear that term interchangeably used with, operator and or general partner, things like that. But there's a phrase in the industry that you may hear often is a good operator can turn a bad deal into a great deal, but a bad operator can turn a great deal into a bad deal. So again, you're really, really betting on the jockey here. So what does that mean? How do we vet our sponsorship team, right? And so there's a variety of different things you really want to look at when you're talking about vetting the sponsorship team. This is a relationship driven business. Ultimately, you want to invest with people that you trust, that and obviously that you like, right? So again, you're putting up $50,000, $75,000, $100,000, sometimes even more than that in these very illiquid investments. And most importantly, you want to preserve both your interest and that hard-earned capital. And so here's some list of questions that we feel like you should be asking on every opportunity when you talk about vetting that sponsorship team. Okay. Things like, what is their track record? What's their level of experience? How many deals have they done in the past? What markets are they invested in? Okay. What's been their history of performance? And this is more on things like distributions, right? Have they met their pro forma projections? Have they met their distributions as originally projected? Who actually is on the sponsorship team? This is very important. How many players are involved within the team and who's carrying what role? Okay. It's very, very important that that's well defined, so people have a defined role and exactly who's operating which part of this moving vehicle. So a lot of people like to put emphasis when we talk about experience on, having enough longevity in the space to have gone through an economic downturn and how they weathered that storm through an economic downturn. I don't want to say this is right or wrong. I mean, that's your own assessment, depending on what your comfort level is. But there's a lot of great people, a lot of successful operators in the space currently that maybe have not been through an economic downturn. Although I would argue that anybody that's been here for 24 months obviously has been going through COVID, and that's new for any and everybody, no matter what their years of experience is. So just a considering factor for you to be aware of. You really want to understand how the sponsorship team is evaluating risk, okay? And how are they mitigating that risk? So if this is a deep value add project, maybe it's a fully vacant building. There are a lot of other risk factors that come in with investing in those type of opportunities versus an opportunity that's stabilized, already cash flowing, and operating well, okay? And so you really want to understand how are they evaluating that risk? And again, what's the strategy around hedging against that downside exposure? So you really want to work with a sponsorship team as well that's have made mistakes. And I know that sounds kind of funny, but you really want a sponsorship team that's kind of been through some challenging experiences and that have learned from those experiences, right? You don't want to be the first one on a team that you're the first time that they've been exposed to making certain mistakes. And look, this is a people business, right? We're all people. We all make mistakes every day, but you really want somebody who's well-versed and well challenged, because it just shows that they're seasoned. Okay. And most importantly, you want to understand how the sponsorship team communicates those mistakes and with their investors. Okay. Transparency is key. And then another important thing, obviously, is to look at what the debt structure is for these opportunities. How are the sponsorship teams aligning the debt with the overall business strategy? Very, very important, especially when you talk about the disposition or exit on these type of opportunities. All right, leading into the second mistake. Brian, you want to take this one?
Sure. Thanks for covering that last section, Cody. So this one is really important, not reading the PPM. So the PPM is the private placement memorandum. And this is a document that's prepared by an attorney when these properties, these deals are being put together, explaining all your risks when investing in a particular offering. And it's really important that you go through these because you really have to know your rights. If you go to the next one, Cody. So what is a PPM? As I mentioned, it's a legal disclosure outlining basically every reason why you should not invest in this offering. So it's going to highlight all your risks, all the things that could potentially go wrong, but also all the remedies if something does go wrong and how to proceed through those actions. So it's going to provide definitions on all your securities and what the exemptions and what the seal qualifies for. And it also outlines who is on the general partnership team, who is the person controlling the deal. Other things it outlines as well are also the equity structure and distributions. And we're going to talk more about distributions here in a second, but this is really, really, really important. You want to make sure you know at the end of the day, how is this deal structured? What percentages to the operator? What percentages to the passive investor? And then also, how are the funds, how are the profits eventually distributed? From, is it monthly? Is it quarterly? Is it at disposition? How are people essentially getting paid? Also, they usually contain an investor deck and company agreement. So you'll be able to go through the company agreements and see what people's responsibilities are in the deal. And it describes your rights as an LP as well as a GP. And one of the things we're going to talk about later today is also to know your rights. You want to make sure you have a clear understanding of things like your voting rights and when you can step in and when you can't.
Thank you, Brian.
Yeah, for number 3, as we just mentioned, we're going to talk a little bit about understanding your rights as a limited partner. So on the next slide, you'll see you definitely don't want to go in blind. You want to make sure you ask really good questions. And one of those really good questions is, do the passive investors have voting rights? How much say do you have throughout the operational process? So for example, if maybe you invest in one of these deals and 6 or 12 months later, it's not going according to business plan, do you have the voting right to step in and either remove the operator or have some influence on the overall business plan? These are questions you're going to be able to find in your PPM and your operating agreement, but it's also a question you definitely want to make sure you ask and have complete clarity on. Removal rights are also really important. As I mentioned, if somebody needs to be removed from the general partnership team, how does that happen? And then also what happens in the case of an emergency? There are things that sometimes happen that nobody can plan for. What if the sponsor, the person that's operating the deal, gets in an accident and passes away? In those situations, what happens? Do his shares get bought by the other partners? Do you have their opportunity to buy his shares? These are all really good questions you want to make sure you ask. Again, just being safe, rather be safe than sorry, right? And the last thing you want to make sure you look for, or one of the last things you want to make sure you ask is, can you audit the books? Can you see the overall financials? Can I see where the dollars are going, and take a look at the overall, not only the pro forma, but how things are actually going? That's a really important question you want to make sure you ask, because at the end of the day, these questions will sort of give you, regardless of whether you agree with the answers or not, they give you some insight on how transparent the operators are. And as Cody mentioned here a minute ago, we believe personally that transparency is key. So we want to provide all these things to our operators before they even get into a deal, sign anything, or wire any funds to us.
Absolutely, Brian. Absolutely. All right. So one of our next big mistakes you want to avoid, and we kind of alluded to this just a second ago, is not understanding the equity structure. Okay. And really, you really want to understand is, how are the distributions being allocated? Okay. And so you'll hear this often, this term called waterfalls. And the waterfalls, basically, that definition just means that it's the outline of how the cash flow and proceeds distributions are getting distributed, and to who first. Okay. And so in what priority. And the reality is these structures can be structured in a countless variety of different ways. And we've seen so many different equity structures, and there's no one right way or the other. But ultimately, it's up to you as the investor to determine what's your comfort level with that particular waterfall structure. Okay. And you'll hear this often in the industry, whether it's an investor-friendly model or a sponsorship-friendly model. And what we're alluding to there is, you have certain distribution waterfalls that would be leaning heavily more into the interest of the investor. Okay. Maybe the passive investors are getting paid first versus the sponsorship team. Maybe they're getting a larger percentage of the deal versus the sponsorship team. And then you have other waterfall structures that are more heavily favored in the sponsorships favor, right? And so typically we see these structures, especially for the sponsorship team side, that are allocated more towards your more experienced operators. Okay. Guys that have been in the business for a long time, they have a proven track record of success. Maybe they've done, tens of millions of dollars worth of transactions and has that history of performance. They could command and demand a higher equity waterfall that is really in favor of the sponsorship team because of their track record. And again, remember, you're betting on that sponsorship team. Okay. So it's just something to take into consideration. There's a lot of incentive-based compensations for the general partners in some of these equity waterfalls. Okay. And so, depending on the type of deal you're looking at will depend on the type of waterfall structure and those fees, that incentive-based compensation. And so you really want to understand that, because you want to make sure that you're aligning with a sponsorship team that has the same incentives that you do. Okay. All right. And our last big mistake that I think is very, very important when you're coming to evaluating these opportunities is, really making sure that you're aligning with the type of investment offerings that fit your investment goals. Okay. And so that suit your own investment thesis. And what do we mean by that? Well, you have to look at your own risk tolerance. Okay. You have to really determine who you are as an investor and what is your investing thesis. Okay. As a passive investor, are you a cash flow investor? Or do you prefer more the equity? Are you looking for those monthly or quarterly distributions? Are you okay with not having distributions, but really just looking for the appreciation and more the equity on the backside of the deal? Okay. So, you could kind of equate that to kind of your low risk, low reward type of opportunities, where you may see a lower cash on cash distribution because you're investing in a safer opportunity. Or maybe you like that higher risk, higher reward. So looking more of those deeper value add opportunities where there's a lot more downside risk, but in exchange, you get a higher return off of that. Okay. And so some people like a combination of both. And so again, there's no right or wrong investment thesis, but it's ultimately up to you as the passive investor to make sure that you understand what is your risk appetite and is the opportunity that you're evaluating in line with that risk tolerance. Okay.
Yeah, Cody, and I think too, something to chime in, maybe diversifying your portfolio as well, right? Maybe you
absolutely
like a little bit of both, right?
Yeah, absolutely. You're absolutely right. So I think it's good to not have all of your eggs in one basket. Maybe you have a certain percentage of your portfolio that's allocated towards your cash flow plays, your core plays, and then you may have a certain percentage of your portfolio that's allocated more towards your higher risk, equity plays. So that's a very, very good point, Brian. Thank you. All right, guys. So at this point in time, we'll kind of open it up to some Q&A. Haley, if you're still there.
Yes, I'm here. So guys, in the audience, if you guys have any questions, be sure to send them to the Q&A box. We don't have any yet, but I do like to usually ask a few of my own questions. So, as you guys have been investing into multifamily let's go back for a second. The PPM. So the PPM usually is like 70 to 90 pages. Do you suggest that someone review that themselves? Do they need to have an attorney review that with them? Are there certain things that they should be looking out for in the PPM? Kind of elaborate on that a little bit.
It's a great question, Haley. And I think it's something very important for every investor to understand. It's so vital, as Brian was alluding to, that you read and understand that PPM thoroughly. Okay. And my suggestion to you is if you don't understand the legal jargon, or some of the definitions within the PPM, I do highly recommend that you probably refer to your legal counsel for review. So that way they can help you to understand what are the risks outlined in the PPM. Okay. Again, that PPM is the legal reasons on why you should not be investing in these opportunities. So you want to understand that. So if you're not the person to understand that, you don't have the experience, you don't understand the legal jargon, I would definitely highly encourage you to consult with your attorney. Okay. Now, maybe you do. Maybe you've invested in multiple of these opportunities before. You've been in real estate for some time, and particularly private placement. So you've transacted in a lot of these and on a passive opportunities. Maybe you don't need to consult with your attorney. Maybe you just need to go read through and exactly what you're looking for in the PPM. But it's so vital that you read through and understand those documents thoroughly. And if you don't, find the right counsel who can help you.
Absolutely. Yep.
Awesome. Great answer there. And we've got another question from one of our attendees. At what point will the sponsorship team provide the PPM to the prospective passive investor? Good question.
Yeah, that's a good question. I think I've seen it a couple ways. Typically, the PPM is usually ready to go when the deal's announced. So if you're on, say, for example, an email distribution list, like if you're on our investor list and we have a particular offering, we're usually going to do some sort of announcement like, hey, all of our investors, we have an offering coming up. And usually we're going to announce the offering, and either it already has a PPM available at announcement, or we'll make it very clear on the announcement that we're just letting everybody know that this is coming up. If you're interested, go ahead and reserve your spot, because a lot of these deals can get funded very quick. There are several operators in this business that raise $3, $4, $5 million in a matter of 3-4 days. So seeing that sort of on the front end, going, okay, I like this. I like what these guys are offering. Maybe attending the webinar. Usually it'll be very clear on either the webinar or on the email that the PPM will be ready in 7 days. And obviously, I would never recommend anybody wire any money to anybody until they read the PPM.
Mm-hmm.
I was going to echo that as well, Brian. I think that's such an important nugget for people to take away, is you never want to make any commitment to these offerings without making sure you read those PPMs.
Mm-hmm. Definitely. And this is a good one here. How do you deal with a sponsorship team that is not communicating regularly or clearly with the limited partners?
It's a great question. And unfortunately, we've had several experiences with certain passive investors voicing some of those concerns. Listen, I think there's a difference between some of your newer, more novice operators as it relates to communication versus some of your bigger shops, your bigger operators. The level of communication could change as the sponsorship team becomes more experienced. They have a more robust business, they have more scale. And so sometimes the communication will vary. But I think ultimately, again, remember, this is a relationship business. And so you want to make sure that you're really vetting your sponsors, taking the time to understand how they communicate before you invest with them. And in the transaction itself, you really want to try to be as engaged as you can. And if you're really not getting the level of communication that you are expecting, you definitely want to make sure to continue to report that feedback back to the sponsorship team. A lot of different teams have multiple team members, and they'll have an investor relations person that's allocated towards a specific responsibility. But you want to continue to report that. Ultimately, if it's up to the sponsorship team on how they feel is the effective way to communicate. But once you're invested, it's very, very hard to get out of these opportunities. So if you feel there's some maybe malpractice, or if you feel like there's some bad doing, so to speak, that's going on, then I would at that time tell you to maybe consult with some legal counseling. But ultimately, you're going to have to take the time before you invest in these opportunities to really make sure that you're comfortable with the communication style with the people you're investing with.
Mm-hmm. Definitely. Brian, did you have anything to add to that?
Yeah, I was going to add, I think one way you can also, on top of what Cody has mentioned already, I think a great way to find out, somebody might say, hey, yeah, we communicate by sending a monthly newsletter. I think a good option is to potentially ask for referrals as well.
Mm-hmm.
If you're talking to a sponsor and it's like, hey, I'm very interested, could you send me some referrals to some investors that maybe have invested in your last deal? And then at that point, we can reach out to our database and to our investors who have invested with us, obviously ask for permission, like, hey, would you mind, speaking to this investor who's invested with us before. So I think getting referrals and just hearing from the horse's mouth, so to speak, and hearing from other people who've invested is a great way to also find out what the communication strategy is for those particular operators.
Mm-hmm. Definitely. And I think another thing too, from my personal experience, with Quest, we attend a lot of events. A lot of these groups, I've been attending events for, 4 or 5 years now. Only invest with people that, well, the group, if they're involved in like a really solid network or, something like that. The more you invest with people that, you all kind of work together, I think the more chances you have of success there as well. This is a good question here. And before I ask this question, obviously, guys, attendees, we're not here to pitch investments or anything like that. Cody, Brian, I know you guys know this, but I think we could definitely approach this one from an educational standpoint. One of our attendees wants to know, can you provide the typical equity sharing structure of Blue Oak? Do you use waterfalls or incentive structures? Kind of just walk us through a little bit how you guys structure things. And again, obviously, like from an educational standpoint.
Yeah, absolutely. It's a very good question, and we appreciate that. And so at Blue Oak, we believe in simplicity. There's a variety of different ways, and these equity waterfalls can be structured. And especially right now, with yields getting harder to come by, deals getting harder and harder to come by, we're seeing a lot more creativity in the cash flow models and equity waterfall structures in some of these offerings. And so you have to be very, very cautious of that. And so for us, again, we like the simplicity of a straight equity model. So we typically do an 80% allocation to our limited partners, 20% allocation to us as the general partners. And we typically don't provide a preferred return, which is another probably webinar we can go down. But as an investor, that's something, again, that you'll just have to determine for yourself. Is that something that you're going to command as an investor? Do you want a preferred distribution, which means that you, as the passive investor, are going to get paid first before the sponsors? If that's not something that's as important to you, then maybe that's irrelevant. But again, we like the simplicity of just a straight equity split. It's easy to explain. There's no confusion. There's no really complicated waterfall structure. Both the operators and the passive investors are getting paid at the same time throughout the duration of the holding period. And we just feel that keeps the alignment of interest with both us as a sponsorship team and our investors throughout the entire project. So, Brian, would you have anything to add to that?
No, I agree 100%. We're a big fan of just keeping everyone motivated and incentivized. So nobody likes to work for free is kind of what we say. This is a tremendous amount of work. So I think the opportunity to provide tremendous value to our investors who we're partnering with, and then also to keep our business going, is really important. So,
yep.
Nice. Great information there. I like this question. One of our attendees wants to know, do the passive investors usually have the right to vote out the lead investor in case they feel something is wrong with the ways the business is running? Do they have that right?
Yeah. So in certain structures, you absolutely do. The passive investors will have that right. And we've actually ourselves have come across a couple of opportunities that have hit the market from situations in which the passive investors collectively felt like the operators or the asset managers were not being diligent in the way that they were operating, and actually voted the general partnerships out of the asset management. Those are never good situations to be in. I feel like both parties unfortunately lose in those situations, but that is something that's a very important voting right for you collectively as passive investors to have, because ultimately you're in here to protect your interests and your hard-earned capital, right? And so when we talk about understanding your risk tolerance and such, I would include voting rights in that. Some people don't care about voting rights because the reality is as passive investors, your influencing power is very, very limited, but you want to be able to capitalize and maximize the amount of voting right and influence that you do have as a passive investor. So, every operator is going to see this differently. Not every operator is going to provide those voting rights. But again, it goes back to the importance of reading through those PPM documents and really highlighting that and understanding what those voting rights are. And, personally, Brian, you probably agree with this, right? As a passive investor, I want as many voting rights as I can.
Oh, yeah.
Yeah.
Definitely. And it's definitely something important to look at because, again, not all structures might include that option for you guys.
Sure.
I've got one of my own questions as well. What markets are you guys currently investing in? What markets are you avoiding? Kind of give me a little bit of background about why for both of those. So what markets are you guys investing in right now?
So we're currently focused across the primary and secondary markets here in Central Texas. We like markets in East Tennessee and then Kansas City, Kansas and Missouri. And so that's our predominant areas of focus. Ultimately, it really boils down to just a market that has good, solid fundamentals from everything from population to economic drivers, potential job growth, and things like unemployment rates, crime rates, and such. We really, most importantly, put an emphasis on landlord-friendly states. We don't want to be invested in states in where the laws favor more so in the residents or tenant side, only because that poses a lot of challenges for you as an operator in being able to execute your business strategy and whatnot. So, that's our typical focus right now. We're open to going outside and looking at other markets, but we have a predominant footprint here across Central Texas, Tennessee, and Kansas City.
Nice. Brian, anything to add to that?
No, Cody hit the nail on the head. As far as quality of assets and things like that, Cody, to allude on, we talked a little bit earlier about risk tolerance. I know personally, we prefer more of the workforce housing space. So that's going to be, your C plus, B minus type of assets. And, they sort of grade those levels based on the quality of the asset. So essentially, we're looking for opportunities where we can ideally have cash flow day one, if not shortly out of the gate. So that we can go in there and implement our business strategy and not need to do necessarily a heavy renovation or a heavy rehab. We want to find something that's already stable that allows our investors, as I mentioned, to sort of cash flow out the gate. Although every deal is different, if we find a great opportunity that's a little bit different, that has a little bit more opportunity on the back end, we won't say no to it necessarily. But sort of our buy box is definitely looking for those more higher quality assets, things that are built a little bit newer in the past 20 years, give or take. So that we can, have a little bit less headaches from repair and maintenance and things of those nature. So just a little bit more detail on the types and quality of asset we look for.
Nice. Very interesting. All right. Just a couple more questions here. To all of our attendees out there, y'all have had great questions so far. So if you think of any others, keep them coming. We do have time for a few more. One of our attendees wants to know if the general partners are advertising a 3-1-1, and as the passive investor, your criteria is a 3-year hold and they agree to distribution on year 3. How do you secure that commitment from the sponsor?
They're talking about the debt, Cody.
Yeah. It's kind of interesting. So you really have to look at the overall business plan of the deal. And I'm going to try to answer this or articulate this in a way that hopefully answers the question. But, with an opportunity that has a 3-1-1 structure, that would indicate to me that the sponsorship team is really more looking for probably an overall business plan that has a 5-year hold with the potential to exit at year 3. But their 1-1, that each year extension is kind of that primary strategy in getting to a 5-year hold. Okay. And so, if you're looking to exit in year 3, I think it's very, very important to raise those questions with the sponsorship team prior to making that investment, because ultimately, if they decide to hold for the duration of the 5-year period, or let's say there's a contraction in the market or even in the capital markets that would force them to hold the property for 5 years, you want to really make sure that you're okay with understanding that that could be a potential risk for you and being into a longer term hold. So I don't know if that really answered the question, but again, I would just have that dialogue with your operators prior to the deal. And ultimately, I think it's going to be up to the sponsorship team to figure out what's best suited in their strategy based on how they've purchased or got the deal under contract. And again, if it's not in line with your strategy, then that may not be the right opportunity for you.
Yeah.
Did that answer the question?
I was going to say, Diane, to answer Diane's question, like there's no direct way to guarantee that they're going to exit year 3
Right.
as you're hoping for. It's really going to be dependent on, like, as Cody said, where's the market at? If property values drop, not significantly, but even a little bit, they may decide to execute those 1-1s, which are essentially 1-year extensions to the debt service they had, which is a bridge loan. So it's really going to depend on the market cycle, and the sponsor won't be able to make any guarantees because nobody has that crystal ball to really know what's going to be happening in 3 years. They can sort of project that, okay, we plan on either refinancing and returning most of your capital year 3, or we plan on just disposing of the asset at the end of year 3. But if market conditions aren't good, we still may execute the full 5-year hold.
Great information. And she did confirm that did answer her question. So even I learned something with that. So great information there. Kind of to, lead into wrapping it up here. Let's talk a little bit about the event that you guys host in Houston. You've got an online networking event going on tonight. Tell us about those, how people can find that information, how people can reach out to you if they want more information. And then we'll kind of wrap it up from there.
Cody, you got some next slides.
I was going to say, let me, if it's okay with you, Haley, I'll go into some of the next slides here. So,
of course.
So for anybody that's attending today, if you really want to learn more about how to evaluate some of these opportunities, here's our most recent ebook that we just put out. It's called How Savvy Investors Evaluate Multifamily Deals. And we really go into a lot more detail on really what does it mean to really evaluate these offerings, when you're looking at these type of investments. Okay. And so you can simply scan the QR code there, or you see our URL, www.blueoakinvest.com/evaluate to receive your free copy of that ebook. And I'll give anybody just a couple seconds there to scan that if you want. 2, 3, and we'll move on here. If you love podcasting or you love learning through audio platforms, we have a great podcast that's been ongoing for almost a year and a half now. We just released episode number 78, and we really talk to multiple industry leaders throughout the space that are both active and passive investors to help you learn more about investing exclusively in multifamily real estate. And so if you'd like to learn more about that or tune into the show, here's our QR code for you to tune in there. We're streaming on Apple Podcasts, Google Podcasts, Spotify, and Stitcher. And if you like what you hear, definitely make sure to leave us a written rating and review, and make sure to subscribe to the show. We release one episode every single week. And if you want to learn more about our meetups that you were just alluding to, Haley, as you mentioned, we host both a live and virtual meetup. So our next virtual meetup is actually tonight. We have a very special guest, a distinguished guest, Mr. Gino Barbaro from Jake and Gino. And then our next live in-person event will be right here in Houston, August 12th, with our very special guest, Mr. Joseph Bramonti, right here at Wildcat Golf Club in Southwest Houston. So here's your QR codes for those events. If you want to get plugged in to kind of keep up to date on all of our future events, make sure to join our Facebook page, the South Texas Multifamily and More Facebook community, and as well as subscribe to our website as well, so you can get all of those details for all of our upcoming events. And so as far as being able to connect with us, here's some of our different ways that you can connect with us. Brian and I are both very, very active on social media, and particularly LinkedIn. So if you look there at the bottom, you can find us at Cody Laughlin 86. I go by the hashtag Real Estate Cody, and Brian Alfaro 89. Again, there's our meetup. We have a great blog that we put out once a month, some great articles talking about all things related to multifamily investing. And then you can visit our website at www.blueoakinvest.com. So, Brian, anything we missed there?
Nope. I think you hit the nail on the head. We appreciate the opportunity again, Haley. Hopefully we're able to add value to everybody who's either on the call right now or goes back and watches the recording. Again, we truly appreciate it and look forward to staying connected with Quest.
Awesome, guys. Thank you so much for joining us today. And to all of our attendees out there, make sure to take advantage of those resources. Whether you're in Houston, go attend their event in person. I've been myself. It's great. I made some great connections there. And I look forward to joining the online one as well. So y'all have a great day. Thank you so much for joining us. I think this class was very educational. And to all of our attendees out there, we'll see you at more of our upcoming webinars. And if you are in Texas, be sure to join us at our grand opening events in Houston, Austin, Dallas, all starting on next Tuesday. So y'all have a great day, and I hope y'all enjoyed the class.
Thank you, Haley. Thanks, guys.
Thank you.
Awesome. Bye, guys.